From the guy that are trying to sell their assets, they say that's fantastic. The guy that's trying to buy, they say it's not.
If you are truly talking about prime offices, and if your office is truly prime, then yes, I definitely think there are opportunities there. But I think once you sort of move off prime, either location or quality, then the market kind of thins out rapidly.
Don, it's a pleasure to have you here in London. We had a big event here. You were one of the opening panelists here. And I grabbed you and said, let's talk a little bit on the cameras here, because I believe that there are a lot of information and ideas that you can share with our audience from all over the world. But before we go there, can you explain to everybody what LaSalle does and also your role? You have been with the company for 8 years, but since a few months back, you started a new position, which is quite strategical.
Thank you so much for having me. Yeah, great to be here at the GRI Commercial Real Estate Europe and Data Centers Conference. As you say, we've just had the opening talk show where I was lucky to be able to talk a little bit about our upcoming 2026 outlook. So at LaSalle, we're a full spectrum, but purely real estate dedicated investment manager. So we're investing in all of the four quadrants of what we might call real estate, so public and private side, and then also equity all across the risk curve from core to value add and opportunistic funds, and including a big debt lending platform as well. So in terms of my role, I lead on the research and strategy side for that debt fund series in Europe. And yeah, as you say, just from the 1st of October, I started a new role as chief economist. So my view in that role is global. So we're looking all around global macro, looking at different countries and different regions and kind of how that helps us to sort of target our strategy. But yeah, I'm based here in London at LaSalle's office at 78 St James's. And of course, from my background, I've got a little bit of a Europe focus. So I still kind of lean that way, but getting to learn more about different global real estate markets outside of Europe.
And when it comes to the 2026 outlook, are you optimistic? Do you believe that we're going to have a great year in Europe? Any challenges in different markets? How do you see the next year?
Yeah, we are optimistic. Yeah. So we had loads of fun writing our 2026 outlook, riffing on loads of ideas with films and movie references, because when we sat down to start our 2026 outlook, we looked back at our 2025 outlook and what we expected for 2025, where our theme had been all about the dawn of a new real estate cycle. It was all about morning, lots of metaphors about breakfast and getting up and going. And we were expecting this kind of significant recovery in European real estate markets in 2025. Various things obviously have slowed that down. So we've seen things like tariff policy out of the US administration that's been kind of weighing on confidence, weighing on sentiment. So writing for 2026, we are optimists and we are expecting more of a kind of rebound in transaction volumes and investment market activity. But we're asking ourselves, are we like Bill Murray in Groundhog Day? Are we just kind of waking up, listening to the same market mood music again? Are we stuck in this sort of Groundhog Day loop? And we think that like Phil had to do certain things to kind of, Bill Murray's character is Phil Connors, he had to do certain things to break out of this loop. So we ask ourselves, what things do we think real estate needs to do to break out of this loop and kind of regain that investor excitement? And we thought that most of those conditions are in place. So we've got mostly rebased valuations. So you're seeing bid offer spreads close and buyers and sellers agreeing more on where pricing is. We've seen pricing more stable through 2025. We've seen occupier fundamentals staying pretty strong. So, top rents across asset classes, including office, prime rents doing really, really well. Obviously, there's some pretty big divergences between prime and sort of average or secondary quality assets for sure. But broadly, the supply-demand balances in a lot of real estate sectors and a lot of European markets, we see those as quite strong. And finally, and this is something that's really changed, I think, quite fast through summer 2025, is that we found debt becoming more accretive. So especially in Europe, where we're doing a lot of Euribor referencing floating rate lending, you've seen the reference rate come down as policy rates have been cut. But you've also seen margins compress as lenders get back into the market and start kind of competing for deals again. And that really helps sponsors who are looking to use leverage to fund either acquisitions or to fund perhaps development projects. That accretiveness of debt is the kind of oil that lubricates those business plans and gets that activity going.
And is there any specific region or country that you believe that can benefit the most of the conditions for the 2026 scenario?
Yeah, this is an interesting one because in terms of sort of a broad global cycle, you've got countries like the US and UK where maybe inflation has stayed a little bit higher and that's kept policy rates a little bit higher too. Some jurisdictions, ECB, so covering the Eurozone in particular, and then also Canada, they've been able to focus a little bit more. Inflation hasn't been as persistent. They've been able to focus a little bit more on supporting the demand side, laid markets, so they've been able to kind of cut rates. And then you've got Japan, which is in a different part of its cycle completely, with the return of inflation to somewhere near target or above target for the first time in a generation. So the Bank of Japan is kind of between holding rates and increasing rather than between holding rates and cutting. So depending on what you're looking for and what your capital wants to do, I think there's it's a bit like a buffet. You can kind of pick and choose different jurisdictions that are doing different things. But we certainly see opportunities in all three major global regions: Europe, North America, Asia Pacific.
When it comes to asset classes, recently we spoke to members in Abu Dhabi, and a lot of them mentioned data centers and the living sector as the two safe bet, if one would say. Would you agree with that? Where do you see the best value in the next 12 months?
Yeah, excellent question. We had a really good chat on the panel about this sort of idea that affordable housing and data centers are in some ways at the opposite ends of types of real estate, but they're viewed as sort of closer to infrastructure by infrastructure type capital, which I think is really interesting. So for me, the risks in those sectors are very different, but the fact that you've got similar capital competing for them is, it says something about how the risks in those sectors are perceived. I think for us, we've been active as a lender against data centers in the past. Residential and living sectors, certainly, we see opportunities there. And we've had a lot of good opportunities in the hospitality sectors since the COVID reopening as well. Mm-hmm. So we like hospitality. On our value add fund side, we've been active since the COVID reopening and up to the present day in retail as well, where you're seeing that really kind of repricing has led to really advantageous potential entry prices, and you've got good kind of footfall and good revenue being generated in stores. If you're picking some specific kind of either prime high street spots or outlet center spots, we see opportunities in retail too.
What about the office market? Because a lot of members have been discussing, and I hear different messages. From the guys that are trying to sell their assets, they say that's fantastic. The guys that are trying to buy, they say it's not, the price is not right there yet. Do you have any views on the market, not just in Europe, but in the US as well?
Yeah, absolutely. Office, as you say, it's a little bit more, we're necessarily a bit more selective in office for sure. It's one where we still think you've got to really understand your market and know what you're doing, and especially understand where the quality of your office property is being pitched relative to the market. Because I think prime office valuations have been solid this year, and on the fundamental side, in terms of demand, we've seen prime rents doing really well in Europe, particularly in London. So if you are truly talking about prime offices, and if your office is truly prime, then yes, I definitely think there are opportunities there. And we've been active also in prime Paris offices too. But I think once you sort of move off prime, either location or quality, then the market kind of thins out rapidly, both from an occupier side and in terms of capital appetite. So yeah, we'd be much cautious about moving off prime. And I think that's perhaps even more so true in the US, where we think that in the non-prime office segment, people are just really underestimating the amount of capex that's necessary to keep an office kind of attractive and retaining tenants.
A final question. If you had to pick one main trend that you believe that we'll see in the real estate industry in the next maybe 2 to 3 years, what would that be? Is there anything that's, is capturing your attention at the moment, and you think that developers, property companies, funds in general should be mindful? Would that be AI or anything else that we are not discussing as much as we should?
Yeah, AI I think is a great one. I'm really interested to see how the AI boom and the data center boom shakes out, but I'm not an expert in that. I think it'd be really interesting from a labor economics point of view as well to see how people are incorporating generative AI and things like that into their jobs. It's certainly something I'm looking at in mine. But the trend I'd pick actually, I think, is development. So in our 2026 outlook, we've got a chart that shows, based on what we know about permissions and construction starts, kind of shovels in the ground type stuff, globally development falling to kind of lows that we have possibly never seen before, certainly in the time series that we've got. So we're just really seeing supply come down really, really fast. And that's a combination of, increasing hard costs and land costs, regulatory and difficulties getting through planning, permissioning, and then a lack of certainty around where exit values are from the point of view of developers. So I think a trend over the next couple of years is if and how developers come back into the market and we see new stock being built again.